How much is green investing changing the financial services sector? How quickly are investor preferences shifting? And what kind of business and regulatory implications does this have for firms? The COVID-19 experience might have distracted us for most of the year, but one of the hottest issues in financial services before the pandemic was the rise in requirements and customer demands around investing with environmental, social, and governance or ESG criteria. I'm Scott Martin from Deloitte Centre for Regulatory Strategy, and you're listening to Regulated Radio. I'm excited to have James Alexander and Isha Gupta on the show today for our latest Working From Home podcast. We'll be talking about how regulators have been approaching ESG issues in the investment management sector, how some firms have been responding and taking advantage of this trend, and what regulatory pinch points we see for them on the horizon. This is an issue I've been really keen to have on the podcast all year, so let's dig right in. This is Regulated Radio. If you think back to the early part of this year, before phrases like social distancing and the R rate all made it into our vocabularies, one of the most notable trends in financial services that I remember was a large number of investment managers making high-profile statements about their intent to only invest in assets that met a variety of ESG criteria that they had set out. This shift towards ESG has been driven by significant societal pressure, changing investor preferences, and as we'll hear on the show today, an evolving wave of new regulatory requirements that look set to change the way that firms, and particularly investment management firms, will need to communicate with their clients about ESG choices. I think very few people will doubt that we're really at the thin end of a wedge today, and that societal and regulatory pressure around green or ESG finance is something that is only set to grow. So let's get started. I'm really happy to have James Alexander join us on the show today. James is a director in Deloitte's UK investment and wealth management consulting team, and he's been doing a lot of work recently to help our clients understand the strategic implications of this shift to ESG investing. James, it's good to have you on the podcast.
Good morning. Thank you.
So, James, as we've been saying, sustainable and ESG investing are things that a lot of people are talking about today. They're certainly buzzwords in the financial sector. But looking back a little bit, how have you seen attitudes towards this kind of activity evolve over the last few years in the investment management sector?
So I think that the sector has been on a journey really for this over kind of the last 15 years or so, kind of thinking back to kind of 15 years ago where things like the United Nations Principles for Responsible Investing came in. And initially when those came out, a very small number of managers adopted them. Over the next few years, those became pretty standard, really adopted by most managers, and kind of a bit of a necessary hygiene factor, particularly for attracting institutional investment. I think what we saw with those was that they had a relatively small impact on firms in reality. They required a little bit of thought and kind of adjustment of the investment process to kind of just think about some of these wider ESG issues, but they weren't placing them really front and center. I think what we've seen kind of in parallel with that over the last 10 years is a emergence of dedicated, explicit, sustainable investment or ESG products. Flowing through, particularly in the last couple of years, to a number of index-related products, giving you kind of ESG-flavored products as well as your vanilla indexing. But I think the interesting thing that we've really seen over the last couple of years is a real focus on this topic, particularly kind of, I would guess, over the last 12 to 18 months, where ever more interest on this topic and really people thinking about it much more fundamentally now, and about how having a very clear ESG proposition becomes, for some segments of the market, kind of an absolute necessity. We certainly have some clients who have lost mandates because their ESG proposition wasn't up to scratch. But equally for other clients, really seeing this as a sort of source of competitive advantage if they have a strong proposition in this space.
Just thinking about the scale and importance of what it is that you're describing, I'm wondering how significant of a shift do you think this is for the investment management clients that you've been working with?
I think it's been quite fundamental, actually. I think what we've seen is an increasing number of clients, both in the institutional market and the wealth management market, taking quite a strong stance around this. Some very much driven by kind of end investor preferences for these ESG issues. Clearly, the climate change part of that has come up the agenda and popular awareness quite substantively and significantly over the last couple of years, which has been a big driver of that. And so what you see is big investors taking quite a strong view, requiring both the mandates they give to investment managers to have kind of an ESG flavor to them, but also importantly looking at the kind of how the investment manager themselves as an entity kind of performs on ESG criteria, becoming very important. So that's kind of, I think, a key driver on the client side. Clearly, in a European context particularly, we've seen the regulation coming through and really kind of putting this to the front and center, with kind of revisions coming through of things like the UCITS AFMD, but also kind of MiFID changing the requirements there quite substantively for firms. And so there's now quite a strong regulatory driver for compliance with this, really making people think quite fundamentally about how they see ESG now.
Yeah, I'd like to bring in our next guest, Isha Gupta. Isha is a colleague of mine at the MAS Center for Regulatory Strategy. She works in our investment management team, and she's been looking more closely at ESG issues this year. Isha, it's good to have you on the podcast.
Thanks for having me on the show, Scott.
So Isha, as James was just mentioning, regulatory change around sustainability and investment management is a trend that we're seeing really accelerate recently. I'm wondering, what are some of the most interesting regulatory initiatives in this area that you're seeing right now?
So I'm sure you're aware that at this point, there's quite a long list of sustainable finance regulatory initiatives. Rather than listing them, though, I think it's interesting to note that they fall into 4 main categories. So we've got labeling, disclosure, risk management, and suitability. So within labeling, we've got the taxonomy, and we've got the new eco-labels being developed for sustainable finance products. And then we've got disclosure under the Sustainable Finance Disclosures Regulation. We've got the NFRD, we've got the TCFD. Then we've got risk management in the form of incorporating sustainable considerations and factors into UCITS, AIFMD, and MiFID II, as James mentioned, and potentially also risk management to be incorporated into the Investment Firms Directive and Investment Firms Regulation down the line. And then we've got suitability, which I think is really, really key in bringing the whole process full circle and really bringing the client's preferences into the picture. Zooming out a bit, though, I think what the regulators are essentially trying to do is to codify and kind of create a structure around what can be a vast, endless subject in order to create some kind of clear obligation and accountability on financial services firms and on investee companies.
But Isha, why do you think this has become such a serious priority for regulators over the last couple of years? And what I mean by that is I'm sure regulators have had this on their radar for longer than many of us will give them credit. But it certainly feels that in the last few years, this has gone from maybe priority 5 or 6 to priority 2 or maybe even 1. What do you think is driving that?
So I think in the context of the EU, sustainable investment is intended to play a kind of key role in meeting the policy objectives under the European Green Deal. And the European Green Deal is actually an EU initiative created with the intention of complying with the Paris Climate Agreement and the UN 2030 Agenda and Sustainable Development Goals. More widely, though, I think that social awareness about the impact of humans on the climate and about human rights issues more generally, but also in several parts of business chains, has kind of grown tremendously over the last decade. And particularly with the advent of social media, I think that investors and consumers have been able to come together with other like-minded people who want to bring about positive change, and that think that they will benefit all, a positive change that they think will benefit all stakeholders. And I think that the regulators recognize that in order for financial services to continue to deliver the right level of consumer protection and meet wider social obligations, and basically to remain relevant and competitive, regulations will need to keep up with the changing times and the new expectations of the public, and also the changing needs of the economy as capital moves towards cleaner energy and other positive social initiatives.
All right. Now, James, turning back to you, as we said at the top, you spend a lot of your time working with a number of our clients that are facing this wave of regulatory change that Isha was describing. In your view, how much of a challenge will implementing these new requirements be for them?
So I think the important thing really to understand is that these changes are really quite fundamental and ultimately will run kind of end to end through investment and wealth managers' organizations, touching pretty much the whole of the business. So clearly there's a lot of work on front office and investment processes, making sure the ESG criteria are integrated into those. That poses some interesting questions about how you do research, but also how you consume and process data that helps you to do that. That kind of then flows through to the client's end of things about how do you do client reporting, how do you respond to client queries during due diligence and RFP exercises about this. Again, there becomes kind of quite a big data management question around integrating both what you're doing from a portfolio management point of view, a research point of view, and then reporting that back in a way that's engaging and meaningful to clients to demonstrate that you are indeed meeting those ESG promises. So that kind of really is quite fundamental. As I touched on earlier, I think there's also an important part about the management company entity itself and aligning its activities, behaviors and policies with an ESG kind of mindset, which is very important. And then finally, I think the one that increasingly we're having a lot of conversations with clients, and perhaps the wealth management industry is not quite as far forward in its thinking as this as the investment management half of the sector, is that the changes to MiFID II are going to really put a big burden of responsibility on wealth managers when they do suitability reports for clients to really take into account clients' ESG preferences, and in quite a granular and detailed way, thinking about each of the kind of E, S, and G parts in parallel, much the same way that kind of today we think about clients' attitude to risk, kind of tolerance for volatility, capacity for loss, and have quite a rich kind of dialogue with the client around investment risk. That now needs to take place for kind of ESG as a set of risk factors as well. So that's quite substantial, I think, as something that the wealth management industry in particular, I think, has got quite a lot of work to do between now and when those regulatory timelines come to hit.
If I can just pick your brain on this a little bit more, and I'm wondering, in your recent experience with clients, what are some of the best practices that you've seen at firms that are really leading the implementation of these new requirements and almost putting themselves in a position to take advantage of this change?
So I think the first thing to say about that is that there are broadly two kind of approaches that we see. The first approach, which is I think the kind of the market leading one, is people who have really wholeheartedly embraced this and embedded the principles behind ESG at the heart of their firm and the heart of what they're doing, and really see doing this the right way, doing this as the right thing as an opportunity for real differentiation and competitive advantage. And so they are really thinking very hard about this, taking quite significant steps to, in some cases, really kind of reinvent their investment processes to place ESG at the heart of them, but also thinking through the whole of their organization, their carbon footprint as an organization, how they kind of set themselves up from a sort of social responsibility perspective and so on. At the other end of things, I think there are other people who very much see this as an important thing and something that they need to take seriously, but very much see it as being something that everybody is going to do. And so really they look at this as something that they need to do to remain compliant and kind of in line with their client expectations, but see it as something that everyone's doing and not necessarily a massive change, and in some cases not a huge evolution from what they're doing today, and definitely aren't seeing it as that kind of real opportunity to kind of create a competitive advantage and differentiation. So I think there's two very different approaches there, but I think what's common across kind of the people who we see as kind of best practice in this space is starting thinking about it from a kind of corporate strategy point of view, thinking about what the impact the regulation and compliance client demands are on your business model, and then working through end to end from the organization how it impacts your front office and investment process, thinking about how it impacts your client service and client reporting, thinking about how how the back and middle office can then support that. So really taking that kind of end-to-end integrated approach to it and thinking it through carefully.
All right, Isha, I wanted to turn back to you for a few questions on the regulatory side of things. And James was just mentioning suitability as an important area of the regulatory developments we're seeing around ESG. And of course, suitability more broadly has always been a top priority for regulators. I'm wondering, can you tell us a little bit more about the relevance of suitability requirements for ESG investing and what you're seeing?
Yeah, so just a brief recap of the new suitability requirements. So firms and individuals that are providing portfolio management investment advice will be required to obtain clients' sustainable, i.e. Environmental, social, and governance preferences. I think this new development is actually crucial because in order to ultimately serve the end client, it's important for investment managers to ensure that clients actually understand what sustainable investing is, its potential effect upon the risk profile of their portfolio, and what they can actually achieve through it in a wider sense beyond the portfolio. Given how broad the area of sustainability is and the fact that it's still a novelty relatively, clients may have very different understandings of what sustainable investing means, and they'll of course have varying levels of risk appetites. So I think that's why suitability is really key. And given that it's an annual requirement, I think it'll probably remain on top of the agenda for regulators for quite some time.
I'd like to ask just a really simple question to clarify something, because I think I, like a lot of people, fill out the annual suitability questionnaire that we get from our investment managers. But what you're saying is that this isn't clients requesting to have a questionnaire about their ESG preferences. These are questions that they will receive whether they ask for it or not, and might be prompted to show they have ESG preferences, even if they wouldn't take the initiatives themselves. Is that right?
Yes, absolutely. So as a client, you wouldn't have to state or suggest that you may have ESG preferences. This will be, the onus will actually fall on the investment manager to actively seek sustainability preferences from their clients.
That's really interesting, but it leads me to think, what do you anticipate some of the challenges might be for firms that might arise in obtaining the sustainability or ESG preferences of their clients?
I think there'll probably be a few challenges, and I think as firms kind of advance in their implementation of the new rules, we'll probably find out what some of those challenges are more on a practical level. But a few come to mind at the moment. So I think starting from the basics, it'll be really important to make sure that clients have a good understanding of what sustainable investing actually is and what the different relevant definitions are. But the key is to explain these definitions and explain the relevant issues to the clients in simple, comprehensive terms so that before a client even attempts to fill out a questionnaire on their sustainability preferences, they actually have an idea on what's actually on offer. Secondly, I think it's well known in the industry that the availability of good quality data from investing companies is still very much a work in progress. And companies at the moment are continuing to refine the type and quantity of data that they're disclosing. But investment managers will need to be very mindful of this whilst, for example, creating potential performance scenarios to include in suitability questionnaires. So, for example, if they want to illustrate how a portfolio may perform with X% of ESG compliant stocks in it and so on, they'll have to be mindful that the data that they're working with is probably incomplete at the moment. And I think another important issue is identifying whether clients' responses about their sustainable preferences are consistent with their previously stated preferences. And if there are inconsistencies, that these are kind of addressed proactively. So as an example, if a client responds about their sustainable preferences in a way that suggests, for example, a much higher risk appetite than before, or if they're willing to take on much more of a liquidity risk than before, then the onus falls on the investment manager to kind of proactively chase the client and have the relevant discussions with them regarding whether they're all on the same page and whether the client understands all the relevant issues and implications and so on. So I think these are just a couple of the challenges that come to mind.
I think if I could just add a little bit there, I think it's a reasonably easy kind of scenario to imagine in your kind of conversation with your client about sort of different portfolios and getting to a position where kind of the client ends up with a choice of, do I want to invest in a way that integrates some sustainability requirements and probably makes the world a slightly better place and probably doesn't have a huge impact on my returns? or do I want a portfolio that doesn't do that, is a fairly straightforward conversation. I suspect most clients will end up going down the route in that conversation of saying, yes, I'd love the product that has the sustainability kind of approach integrated into it. And I think there are lots of investment managers and wealth managers who've got kind of portfolios out there to address that. I think the regulatory expectation perhaps goes a bit further and expects there to be a much richer, deeper conversation with clients about really understanding their preferences about each element of E, S, and G separately, and then understanding with clients how they would like those preferences to be expressed in portfolios, whether that's through some sort of screening approach or perhaps more of an activist engagement approach. And those conversations become quite complex quite quickly for a lot of clients to engage with, I suspect. But also when you have those conversations, you might find quite conflicting views about how somebody might think about the E part of ESG compared to the S or G aspects. And so thinking about how you then build a portfolio for clients that factor in all of these different elements, which for every client is going to be different, potentially becomes very challenging compared to the current approach of investment management, where broadly speaking, kind of a set of client preferences for ESG are considered to be much more homogenous.
So I always like to end every regulated radio episode asking our guests to make predictions or forecasts about where they see things going in the future. Isha, I'll start with you. And I'm wondering, where should we be looking to anticipate the next big regulatory push around ESG investment?
So my personal view is that as these sustainable finance regulations within the investment management industry start coming into force over the next few years, the regulatory focus is likely to turn towards how firms are implementing the requirements. As you know, there's a formidable array of sustainable finance regulations at the moment that investment firms are currently analyzing and thinking about how to implement. But obviously, no one's done it before. So I think the regulators will be taking a keen interest in the practical approaches that firms are taking. And I think they'll be looking to communicate to the market and start creating precedents around what good and bad practice is in this context.
And James, turning to you, in 5 or so years' time, how much progress do you expect the investment management sector to have made in being able to offer their customers green, sustainable, or ESG investment solutions?
So I think really building on what Isha said, the kind of regulatory direction of travel is pretty clear. So I think over the next 5 years, we'll see the whole market of firms really moving to integrate sustainable investing and ESG into their propositions. I think what's perhaps more interesting is that we're starting to see a number of firms going a little bit beyond integrating sustainable investing and ESG and really embedding that to be absolutely the heart of their value proposition to clients and end investors. And so what for me will be really interesting to see over the next 5 years is whether the people who are taking that approach now will really become new market leaders and as clients embrace that trend, or whether it will remain a slightly more niche area for a smaller proportion of the market.
And James, actually, I think I was just thinking as you were speaking that it will also be interesting to see how these kind of new ESG portfolios, or rather portfolios with a huge proportion of ESG stocks in them, and these new sustainable funds, sustainable ETFs and so on, how they perform over a longer period of time, and how that affects these new value propositions and how this affects investor sentiment. Because I know recently there's been some positive results regarding ESG investments and so on, but I think that they just haven't been around for long enough in a mainstream fashion for us to really know, and for the wider public and investors to really know, what returns are going to be like.
Yeah, no, I think that's absolutely right, Isha. I think kind of, as you say, the majority of the studies on this at the moment seem to suggest that kind of ESG strategies perform as well or even slightly better than traditional strategies over the long term. But I think the impact of sort of sector weightings and so on over time mean that we see that kind of outcome changing over time. And certainly were we to see a period of sustained outperformance or underperformance for sustainable investing strategies, that would have quite a significant impact on adoption, I'm sure.
This is definitely really interesting stuff. James, Isha, thank you so much for coming on the show. It's been great to have you.
Thanks, Scott. Thanks for having me.
Yeah, thanks very much for having us, Scott, and great chatting, Isha.
And there you have it, our latest take on what this critically important trend in society might mean for a critically important part of financial services. I hope you're all enjoying the final days of summer, wherever you might be. Some of you, like me, are probably still working from home now, 6 months on, but I'm sure you're doing your best to keep things going. I'm really happy to say that we're still going here at Regulated Radio, and we're planning a lineup of really exciting shows in the next few months. That said, if you have any thoughts on any ideas or topics that we can tackle with our Working From Home series, please give us a shout at regulatedradio@deloitte.co.uk. We really would love to hear from you. And remember, if you like the show, hit the subscribe button to ensure you receive notifications about our next episodes. And if you're already subscribed, you can give us a review on wherever you get your podcasts. But that's all for now. Thanks so much for joining us, and you'll hear from us again soon.